while being slightly fast-paced. The NYSE American is currently closed for the weekend, and the last reported NUBURU Inc. BURU stock price from the close of the most recent session, Friday, October 10, 2025, was 0.475, marking a 2.88% increase for that day. Now, most investors looking at this penny stock see a high-risk, low-revenue laser company that's barely keeping its listing status, a firm teetering on the edge of irrelevance in the high-tech space dominated by giants like NVIDIA stock in their respective fields. But the reality is far more compelling, and what you haven't likely seen is the profound strategic pivot happening beneath the surface of this microcap's tumultuous price action. This is no longer just a blue laser company fighting for relevance in additive manufacturing and welding. It is aggressively transforming itself into a defense and security hub through a series of high-stakes related party acquisitions and capital raises that have completely redefined the investment thesis. The recent binding agreement to acquire Orbit SRL, an Italian software firm specializing in operational resilience and crisis management, is the key market insight that fundamentally shifts the expectation versus reality narrative for BURU. This move, announced earlier last week, sent the stock soaring by over 26% in pre-market trading at the time, demonstrating the market's initial excitement, but the magnitude of the underlying shift is what many are still underestimating. It's a clear signal that the company's focus is rapidly moving away from its historically capital-intensive, low-margin blue laser business towards a software-driven, government contract-heavy defense platform, a strategy that demands a completely different valuation model than the one currently being applied to this deep-value, highly speculative ticker. The common expectation for a stock like BURU is a slow, painful slide toward eventual delisting or bankruptcy, an outcome typical for technology companies with weak balance sheets, negative shareholder equity, and negligible trailing 12-month revenue, which for NUBURU currently sits at a mere $9.3 thousand. This perception is bolstered by the fact that the company has repeatedly filed to sell substantial numbers of common shares to raise capital, including filings to sell 75 million shares, 30 million shares, and 25.9 million shares for holders just over the past month, signaling massive dilution that terrifies retail investors on platforms like Robinhood and even experienced traders on more sophisticated venues like the Interactive Brokers trading platform. This dilution pressure is a brutal reality, forcing the stock price downward in the long term, pushing it deep into penny stock territory. Yet, the contrarian, deeper reality is that this cash infusion, which recently included a $12 million public offering, is not for propping up the old laser business. It is the fuel for its transformation plan, specifically structured to acquire and integrate new defense-focused assets like Orbit and the previously announced efforts related to acquiring a controlling interest in Tecne, an Italian defense and technology firm. This strategic repositioning is a massive swing for the fences, aiming at the $500 billion global defense market rather than the highly competitive industrial laser sector. The recent price action reflects this deep tension, extreme short-term volatility with a daily average volatility exceeding 40% in recent weeks, making the price movements of even Tesla stock or Apple stock seem tame by comparison. Driven by speculative retail interest and short covering in response to the news, fighting against the crushing long-term weight of significant share dilution and underlying poor financials. For those utilizing online investing tools like SoFi Invest or attempting self-investing with an individual brokerage account, understanding this core conflict between strategic corporate transformation and immediate financial distress is crucial. Diving into the recent stock movement of BURU over the last few weeks reveals a textbook case study in catalyst-driven volatility. The stock has experienced multiple massive percentage swings. From a 52-week low of approximately $0.12 in early September 2025, the price surged by over 280% in just 2 weeks leading up to the most recent close. This dramatic spike was not organic growth. It was a direct reaction to a barrage of press releases detailing its strategic shift. Announcements like the dual CEO structure implementation, the strategic update poised for growth in defense and security, the $12 million capital raise, and the final Orbit acquisition agreement have acted as successive ignition points. The immediate stock market reaction to the Orbit acquisition, for instance, showed the stock soaring 26.8% in pre-market on the news, illustrating how sensitive the small float is to positive developments, especially those tied to a rapidly expanding new business line with projected software model revenue of over $19 million by 2028. This kind of explosive movement is characteristic of low-float penny stocks that are undergoing a significant narrative change. The retail traders on various investing sites are saying load the boat, sensing a potential multi-bagger if the pivot succeeds. However, institutional analysis, like one recent AI-driven score, still rates BURU a strong sell, giving it a low probability of outperforming the S&P 500 in the next 3 months. This stark difference between speculative enthusiasm and conservative financial reality is the lifeblood of its intraday movements. High trading volumes, sometimes exceeding 280 million shares in a single day, indicate massive turnover and short-term flipping, often by users employing Robinhood stock trading strategies or day trading via their Fidelity brokerage accounts, rather than long-term accumulation. The risk is profound. While the short-term gains can be significant, the possibility of a sudden retracement is equally high, especially as the company continues to execute its financing activities, which involves selling more shares, essentially sacrificing short-term share price stability for the sake of long-term funding for the new defense and security hub. The market's excitement is focused purely on the potential future value of the new defense segment, effectively ignoring the grim financial reality of the legacy blue laser business. The price is currently running on the fumes of expectation, creating a disconnect from reality that can only be resolved by concrete revenue generation from the new segments. For a long time, the core business of NUBURU Inc. was pioneering high-power, high-brightness blue laser technology. These blue lasers are physically superior to traditional infrared lasers for welding and 3D printing highly reflective materials like copper, gold, and aluminum, offering faster, cleaner, and spatter-free welds, critical for the e-mobility and consumer electronics industries. Products like the NUBURU AO150 and the NUBURU BL250 were the company's technological anchors. The business model was straightforward, selling these high-tech industrial laser systems and solutions globally. However, as the financial statements starkly show, this model was not sustainable. The revenue remains nominal, and the company has been consistently reporting significant net losses. For the year ending December 31, 2024, the company reported total revenue of just $152,000 against a net loss of over $34.5 million. This explains the desperate and necessary pivot. The transformation, spearheaded by its dual CEO structure and executive chairman Alessandro Zamboni, involves 2 key prongs: recapitalization and strategic defense acquisitions. The plan is effectively to use the blue laser technology as a base, then rapidly layer in complementary, high-growth, and government contract-driven defense assets. The acquisition targets, like Orbit with its operational resilience software, are meant to provide immediate access to markets with higher projected revenue and better gross margins through a software-as-a-service model. The financial health of the company has been precarious, marked by a negative shareholders' equity and high dilution, which explains why the stock has traded in the sub-dollar penny range for much of its recent history. This is the financial reality. A company with a cutting-edge but commercially struggling technology is attempting a radical, structurally complex, and financially taxing corporate makeover. It's an act of desperation, but also one of potential genius if the defense pivot ends, turning a hardware firm into an integrated technology provider that marries blue laser hardware, which has applications in defense, with specialized defense software and systems. This complex situation is one reason why automated intelligent portfolio services from companies like Schwab Intelligent Portfolios or Fidelity SEFs are likely to flag the stock as a compelling buy. Its fundamentals are simply too broken under traditional value metrics. It's a pure high-risk speculation on a major corporate re-architecture, far removed from the stable growth seen in names like Nvidia stock. The institutional activity, while not robust, hints at the changing dynamics. While some insiders have been selling shares over the past year, consistent with the capital raises and prior financial strain, the overall trading volume is dominated by retail momentum traders betting on the acquisition narrative. The volatility is so high that traditional technical analysis models can give conflicting signals. with some seeing a massive breakout from a long-term descending channel, while others, looking at fundamental metrics like the price-to-sales ratio being not meaningful due to tiny revenue, give a strong sell rating. This split opinion highlights the challenge. Are you investing in the legacy business's financials or the projected high-growth defense unit? Investors should monitor the upcoming earnings release, expected around November 13, 2025, which, while likely to report abysmal numbers from the legacy unit, will be a critical forum for management to detail the progress and integration of the new defense assets and the next steps in their transformation plan. Any concrete news on the realization of revenue from the Orbit platform or clarity on the Techne acquisition will act as a major catalyst. Failure to deliver on these defense milestones, however, will quickly erode the speculative gains. The market is not patient with transformation narratives, particularly for highly diluted stocks. The current market capitalization is still relatively small, which means it remains highly susceptible to shifts in sentiment and large